Vincent Deluard is the CFA and global macro strategist at INTL FC Stone. Vincent, welcome back to the show. Let's talk about what's happening in this great rotation that seems to be following up from September. You and I discussed some of the risks about what would happen if bonds had a sustained sell-off. Is that what we're seeing? What does it mean to you?
Well, first of all, I thought you did an excellent job kind of summarizing the big trades. I mean, it's kind of easy to get lost with the market making new all-time high, but your story, the rotation from growth to value, from momentum to smaller caps, I think was really what was important. I think the process has started and it's not going to stop. I mean, we talked about it many times before. All these big unicorns are down big times. Now we have yield curves that are a lot steeper than what they used to be. And this is the most negative environment for a lot of these companies. I think the part where I think maybe I differ from consensus is that I expect this to be inflationary.
So, Vincent, tell me how. Walk me through that, because essentially part of this has been the kind of unicorn blowback, the IPOs just dropping a total egg on the market. I mean, it's rough, it's bad. Uber, we saw it regardless, whether you're selling used handbags or you're doing ride hails or even software. If you have a very tough trajectory to profitability, the market's not messing around right now. Where does that take you on a macro side?
I think ultimately to either both things. Some will go bankrupt, obviously. I mean, you have a lot of business models that made no sense. I mean, I think we're probably looking at that for WeWork and a lot of the consumer-oriented one, or the ones that do have pricing power will eventually increase prices, and that would be kind of a double whammy for the market, because we had, as you were explaining before, this massive deflation trade rates are going to go to zero, and in a way, you can think of it as a self-fulfilling loop. So if I can go back for a bit, back in 2008, we had this massive financial crisis, huge deflationary shock. Commodity prices were down 60, 80%. We had all this debt hangover and rates fell to zero. Because rates were so low and yield curves were so flat, it suddenly became economical to fund a bunch of companies that would not have gotten funded 10 or 20 years ago under normal circumstances. I mean, there is no way anyone would have funded WeWork in the 80s, for example. It's only because rates were so low and so much money was gushing into venture capital that a lot of these unicorns were funded. Now, once you have the money, you have to do something. Well, what you have to do is to get growth. Hopefully you get that through technology, but the easiest way to get good growth is to subsidize your customers. So all the freebies, all the producing below cost, attract new customers. I mean, you can see that I call that the millennial subsidy industry, right? The Lyft, the scooters, the food delivery, etc. And because of that, we ended up with this artificially low level of inflation. If anything, it spread to other sectors of the economy. You can think of Robinhood and the brokerage, for example. Oh, Robinhood is going to zero, we have to go to zero. And that deflationary loop, more money flowing into unicorns cutting costs, is what we've been living in 10 years. And that's what's being broken right now.
So what are then the ramifications, Vincent? Is it going to be the companies that then are dealing with an economic fallout because there will be either layoffs around these unicorns, or there will be tightening of the purse strings so that fewer people in these once lofty parts of our economy have the ability to spend? Because that almost kind of sounds deflationary as well. Or is it that their actually spending power goes down and so inflationary? How do we sort of figure out what exactly the knock-on effect is?
Well, I mean, you have a bit of both. I think at the end of the day, the net effect was deflationary because these companies were subsidizing their customers. They were paying their employee with inflated stock. But on some areas, it could be deflationary. I think we're already seeing this, for example, in the Bay Area. If you look at the S&P Case-Shiller Index, generally, real estate prices are rebounding all over the country. There's only two cities where that's not happening, San Francisco and Los Angeles. Why is that? Well, because these are probably the two cities that are the most dependent on this kind of unicorn stock-based compensation bubble. So I would expect it to be deflationary in selected areas, the one that has seen the most inflation, certainly deflationary for asset prices. But as far as the real economy, I think it could be inflationary. I mean, one metaphor I like to make is, do you know when the in the movie Jurassic Park when the kids are in the car and Jeff Goldblum, don't move. His perception is based on movement. I think this is exactly where most of the economy is at. Everyone is terrified that, the T-Rex in that metaphor is Amazon or some fintech disruptor is going to take their jobs or is going to take their market share away if they increase prices. Now, as we realize that there was actually no magic sauce behind these companies, like all they had was access to free capital and the ability to pay their employees in stock rather than cash. As normal companies realize that, you see some pricing power go back to normal companies.
So, Vincent, what then is the way to express this view through an investment thesis or looking at something like the bond or the stock market? We see that the path to profitability, when it's illusory, is definitely weighing on the company's shares that are public, or we can see it transpire. But the deflationary case, I think, is interesting because while this is happening, we've actually got a bond market that is giving us higher yields despite everyone expecting even more deflation, which is also a little bit ironic.
Right. Well, obviously, the first thing not to do is to not own them. One thing, though, that I don't know if it's a good or a bad thing, but I would say compared to the prior bubble in the late 90s, the public part is tiny. This is really just the tip of the iceberg, right? Most of the damage, I think, is being done and will keep being done in terms of like writing down the valuations that private equity, venture capital firm, or even a lot of the traditional investors have been lending or giving equity directly to these companies. So you will not necessarily see it in the stock market. As far as the case for inflation, inflation-sensitive assets still trade at millennial lows. So you can go through the list. Whether you're a gold bug or whether you can maybe implement it with swaps. They're literally given away, especially if you look outside the U.S. or Japan, where you have this deflationary mentality that's been completely anchored. And then as far as equity sectors, it was basically your presentation. The stuff that people did not want to touch, the banks, the small cap, the value, the rate sensitive sectors, all of these, which are coming back, will eventually benefit as this big kind of growth momentum bubble deflates.
Vincent, to bring this together to one of the other big moves before we let you go here is about gold, because gold for many is an inflationary hedge, but lately it's also been a way to essentially bet on safety against geopolitical calamity, on negative interest rates, and now what we've got is just the slightest hint that things aren't going to be as bad as the market thought in August. Suddenly gold is under some pretty severe pressure this morning. Bonds also as well. Is this becoming a risky trade if the central bank extravagance is on hold for the moment?
Well, gold is a very versatile asset. It can be many things at many different times. Generally it is over time the best hedge over inflation, but as you point out, certainly earlier this year, it became a hedge against central bank insanity and negative rates. Now, I am an irremediable, unconsolable gold bull, so I would actually be, when I see the chart you're showing right now, I'm actually encouraged. Despite everything that we saw, gold hasn't really pulled back. We're still trading at 1,500. Given the huge spike we had, I would have expected much more of a consolidation. If we consolidate on a flat line, to me, that is actually quite bullish. But I think you're absolutely right to point out that, gold, at least in the short term, is not necessarily a bet on inflation. Gold does many, many things, and this is one of the reasons why you want it in your portfolio, because it's a versatile asset class.
Okay, Vincent, we got to run for now. Really good, interesting take as always. Mr. Deluard is a global macro strategist at INTL FC Stone.